Yeah, that reminds me of the story where the guy comes in and he crushed his finger in a vise, and he says, "Doc," he goes, "that will I ever play piano?" And he goes, "Oh, yeah, in about 6 months you should be good as new." And he goes, "Good, I can never play piano before."
This is episode 39 of Farm to Markets, and today we are talking about what to do now that the S&P 500 is down, Vanguard making their target date retirement funds stock heavy, and some lightning round questions at the end. The S&P 500 is down 18% for the year as the Federal Reserve tightens monetary policy to ward off high inflation, causing investors to worry about a possible recession. What, if anything, should investors do right now?
So the first thing that I would suggest is not panic. So what should you do? Not panic. I looked up some interesting stats, and in the last 20 years, there have been an intra-year decline in the S&P 500 in 10 of 20 years. 7 of those 10 times were of at least 15% or more. And 20 out of the last 20 years, though, the S&P 500 has been down at some point during every single year, just about. However, the S&P 500 has only had 3 down years total in the last 20. That's 2002, 2008, we all know what happened there, and 2018. So seeing the S&P 500 down right now is probably unsettling. It's pushing 20% down, but intra-year declines of 15% or more are actually fairly common over the last couple of decades. And according to Schwab, I found this interesting stat out: 80% of market corrections of 10% or greater in total have not led to a long-term bear market. So while, past performance is never a perfect predictor of future events, this is not something that's very unusual. Most of the time, it doesn't lead to a long-term bear market. So my suggestion would be don't panic.
I second Alex. Don't panic. Don't do anything. The vast majority of the time for when markets are down is to not do anything. When markets are ugly, we like to toss around the phrase, don't just do something, stand there. And I think there's a lot of truth to that. However, it's easier said than done. When your portfolio is getting beat up, it's natural to want to react, to take action, and to jump into the fight. But history has shown that this can do much more harm than good for your portfolio. I think we actually did a video on when to sell losing stocks, and that actually might be a good link to reference. So first of all, don't panic, stay calm, and don't sell anything. Secondly, stay focused on your long-term goals. Now, I say long-term goals because short-term goals ought not to be invested in risky assets to begin with. Thirdly, look at the historical charts. I find a lot of solace when I pull up the charts, and I'll actually pull up some right here. Can you see that?
Mm-hmm.
Okay, so this is where we're at right here. 18% down from the peak in January of 2021. So we've still come all this way. If you've been investing anytime between March or anytime before March of 2021, you're still in the money. If you were dollar cost averaging all these years, your portfolio is still up. It's only had 5 months to lose value. Now, if you look at the housing bubble burst here in 2007 and the dot-com bubble burst in 2000, these bear markets lasted years. And at the very bottom of the 2008 financial crisis, that eroded gains going all the way back to about 1997. So yeah, an 18% drop in the market is never fun. It certainly hurts your portfolio a little bit, but look at where we've come and just look at the historical charts. So that's always a good place to reference. Fourth and finally, if you have more money to invest, do it. Now's a good time to put more in the markets.
Is that I always say that if you're following the rules, you're going to be just fine. Even in our portfolios, we have our clients diversified not only by investment but also by strategy, and we actually have some strategies that are actually doing quite well. Our one most aggressive strategy, I think it's up 16% right now, and the stock market down 18. that's a pretty healthy differential between what that strategy is and what the market is doing. Now, certainly there is absolutely no way that I'm going to condone anybody putting all of their money in that particular strategy, but it just goes to show you that not everything is down. We have strategies where we've got quite a few clients right now who are invested in cash and gold, and other clients who are in real estate, but most of our clients have a little bit of everything. And the Bible in Ecclesiastes 11:2 says, "Give your portion unto 7, even unto 8. For no one knows what disaster will fall upon the earth." Panicking when the stock market drops does nobody any good. So the one thing that I would recommend that people do is that if they're feeling like they should do something, ask yourself, what option is better than what I'm doing right now? Because if you take a look at the cost of everything around you, yes, the stock market has gone down, but so has the value of cash. If you have everything in cash, yes, it's guaranteed not to enjoy market loss, but it's guaranteed to enjoy inflation loss, which means that you'll be able to buy less goods and services a year from now than you are today. I think that's really the biggest long-term risk that people have. If you have 3 to 6 to 9 months worth of living expenses in an emergency fund in cash, that's probably plenty. If you have more than that, you may want to consider moving some of that cash from the sidelines, putting it into investments that at least have a fighting chance of keeping their value relative to inflation over the next couple of years.
I'll just say the same thing. I'll just use a baseball analogy. So just like in baseball, investing is a game of averages and statistics. And if game 84 out of 142 game season is not going your way, you don't want to trade all your players and change your strategy. Every baseball team, even the best ones, know they're going to lose some games during the year. And it's the same thing with investing over 30 or 60 years. You're going to have a few down years. You're going to have a few market corrections, and you're going to have a few bear markets. And knowing this, all these events should be baked into your portfolio. And like Joe said, is that we have different strategies, and some of the strategies that we have do the panicking for us. So like our dynamic sector selection strategy is 2/3 in cash and 1/3 in gold right now. And the nice thing is it does all the worrying. So is that we don't have to worry about what the market's going to do. The strategy does it for us. And then when it decides that everything's better, it gets back in the stocks or real estate or whatever the next investment is. So, following your game plan, not changing it just because we're down right now is obviously the best strategy.
So the DSS portfolio is the scrubbing bubbles of our models.
Exactly.
It worries so you don't have to.
That's right. Exactly. I also want to flesh out something. Did you when you said you should start putting some money in? Are you calling a bottom right now? Is that what the
Who, me?
Huh?
Me?
Yeah.
Oh, absolutely not.
Okay. I was going to put it down there, and then we
clear.
can make fun of you in the next episode.
Okay.
We're down further. All right.
Unless I would be right, then we can edit it back in.
Yeah, exactly. Yeah, we could do that through the menu. I was hoping somebody would make some bold prediction just so we could, start keeping track of these things. Yeah. All right, moving on. So is that the Wall Street Journal reported that the Vanguard target date retirement funds, which are popular in 401k plans due to their ability to reduce their risk tolerance as the owner of the fund ages, have been shifting into bonds more slowly than they have in the past, leaving them more susceptible to market volatility. According to the article, the youngest worker now invests 92% of their contributions in stocks, up from 85% 10 years ago. Was this a prudent move on behalf of Vanguard, or should they have left the allocations alone?
Well, I think hindsight is 2020, but just looking at the data that we track on a monthly and annual basis for a lot of these categories like stocks versus bonds, stocks have outperformed bonds 8 out of the last 10 years. And most of those years, it's not even close. I think it's just been Vanguard reacting to the fact that there just hasn't been much of any money in fixed income for a long time now. And that's only now starting to change. But the downside to that is if we look at some of the bond ETFs, they're doing worse than stock ETFs this year. So if they had more money in bonds, they might have actually done even worse right now in a rising rate environment. Um, eh, it's never a bad idea to diversify, but for a lot of these target date funds, especially for younger workers investing in them, it has just made less and less sense to put any money in bonds when there hasn't been any return from them, especially since stocks have had a pretty great decade, all things considered, even including, the COVID crash. Immediately after that, they hit all-time highs. So, only now are people worrying again. But so should they have left it alone? Hard to say. I understand why they did it. In hindsight, it seems right now to be kind of a wash. So maybe going forward, they'll with yields rising, they'll put more bonds back into these, since there'll be a little bit more money in them.
I think it was a prudent move for Vanguard. So far, it's been playing out well despite the recent market pullback. Just because stocks historically carry more volatility doesn't necessarily mean that bonds are riskless. Like Alex said, bonds can certainly go down, sometimes more than stocks. And bonds right now are down. They're not offering much in terms of income or protection. But things can change. Interest rates, economic growth, monetary and fiscal policy, they all affect bonds and stocks a little differently. So right now, I think Vanguard knows what it's doing. If things change, and they might shift back to a higher allocation in bonds. I think Peter Lynch, the manager of the Magellan Fund at Fidelity years ago, he was a big fan of the stock-heavy retirement portfolio. And he argued against the traditional 60-40 model. With Americans living longer and letting their portfolios grow longer, he thought that there should be more allocated to stocks. And I think that there might be a lot of truth to that in the environment we're in right now.
I don't fault Vanguard for doing this from an investment advisor perspective, but from a product and truth in advertising perspective, I'm wondering if they're doing the right thing. Because the whole point of target retirement funds is that you have a specific allocation and you're extremely disciplined on sticking with that allocation, whether or not you think it's prudent or not. Is that it's supposed to follow a particular protocol. It seems to me like they're now wearing our hats and they're actually doing investment advisory services for their shareholders. And when you have trillions of dollars invested in these target retirement funds that are in 401ks and simple IRAs and these sorts of things, and you do this kind of move, if they're not 100% right, I think they're really liable for doing this. When I look at a target retirement plan, I'm expecting a certain kind of product, and it sounds to me like they're shifting away from what we think they are.
So the thing I can't find in the Vanguard target date retirement funds is that, so when Joe says truth in advertising, is that number one is that you always have the ability to look in your fund and see how much is currently invested in stocks. And so you should be able to gauge the volatility of your fund based on just, so if you do your due diligence every year, look at your funds and know how much is in stocks, the volatility should not be a surprise to you because you should know how much is in there. And then they do give investors, you don't have to pick your specific target retirement date fund. If you want to choose like the Vanguard 2065 if the Vanguard 2065 target date retirement fund is technically like your default fund, you can, if you want to, choose the Vanguard 2045 fund if that's too aggressive for you. So a lot of it has to do with actually looking in your portfolio. And I absolutely understand why Vanguard did this. They're probably just looking ahead, looking at the value that bonds were going to provide and looking at their current yields and looking at what was going to happen to a bond fund if interest rates started to come up. And they made what I think is a prudent move. Joe's right. If this had gone backwards on them, they'd have had a lot of fiduciary liability issues. But I think if you look at it, I mean, just the fact that bonds are not adding any value to the portfolios, the bond funds are getting hit pretty hard because as interest rates come up. And I think a prudent investor would know this. And I think Vanguard did a prudent thing by at least slowing the rate in which they convert the stock portion of the portfolio to the bond portion of the portfolio. And I don't think they were taking too much risk by doing that. And then again, this is just one of those things where it's that you as the investor have to look at your portfolio and know that how much is in there, and then think about that in relation to the stock market. So yeah, I mean, certainly on some should they have done or not? I'm going to go with yes, because I don't think the risk of them by adjusting it 10% was that great.
Well, you've seen some of the processes that these 401ks have is they send out these participant handbooks where you go through a particular process that guides you towards a particular target retirement fund. And in the literature, it says you're going to have this much in cash, this much in bonds, and this much in stocks if you are in this particular target retirement plan. Well, I don't know, but has Vanguard changed all of their literature to say, oh, all the stuff we did 2 years, if you're looking at the book you did 2 years ago, it's different now because now we have decided that you actually need less bonds in your portfolio than you did before. This is a fundamental shift away from the whole concept of target retirement funds. Target retirement funds were supposed to be designed for the investor who knows absolutely nothing about investing. And now you're actually trusting somebody to actively manage those target retirement plans for you, when in the past they were supposed to be a passive tool for the prudent investor who doesn't know anything.
I get that. And, judging by, I'm on the Vanguard, because we use Vanguard for some of our 401k plans, and I'm on the Vanguard 401k plan site for investors constantly. And it's pretty easy to see what portions in stocks, what portions in bonds. And Joe's right, is that this is for people who don't want to have any involvement with their 401k. They just say, hey, Vanguard, you do it for me. But the thing that I can't find is that Vanguard never said, here's the formula that we're going to convert stocks to bonds in your portfolio. And I think they left it pretty open-ended. So if there ever came a day where they wanted to, tinker with the rate in which they convert stocks to bonds, they could do it. Because I never said anything that says, hey, we're going to convert this much of your stock portfolio to your bond portfolio over this time period. And I think they basically left themselves a door to be able to mess with that if they wanted to. And then, secondly, is that a 10% change over a 10-year period is not that great, especially when you've only had one fund anyways. You're probably not going to notice it that much. It's not like you've had multiple target date retirement funds. It's not like you had the 2055 fund, then you're in the 2045 fund, and you notice that this 2045 fund is more volatile than your last one. I don't know that I don't know that investors are going to notice that much because it's the only fund that they've ever been in. But Joe's right, is that this is made for people who didn't want to do anything, but I think they left themselves enough wiggle room where they could tinker with their formula a little bit.
At the very least, they should have just sent out a plan participant notification saying, hey, these are some of the changes that we're making to our target date funds. Please opt in or make any changes that are necessary.
I disagree. I don't think they had any obligation to do it because, again, it's like people would just be like, it would just be all like, it would just be gobbledygook to the person reading it because, again, they have no reference for how fast their fund should turn from stocks to bonds. So they just be like, so if they said, hey, we're going to convert less of your bond portfolio or your stock portfolio to bonds this year than we otherwise would have, the investor would have just been like, great. Do I really have to click on this email and like read this? So I don't think, I think when you get the target date fund, you're kind of, you're letting Vanguard manage it. I think they left themselves enough room to do this. So.
Right.
If European interest rates go negative again, it's going to be a strike lawyer's golden opportunity for a huge class action settlement. If people say, well, I thought that I was supposed to have been 15% in bonds, and how come when interest rates dropped negative, I didn't participate in the gains?
And then your lawyer's going to be because you didn't look inside your portfolio and call your financial advisor. That's why. It's because you did nothing. Sorry. All right. Move on to the lightning round. All right, a recent study found that the average person spends $314 per month on impulse purchases. Additionally, the same study found that the same average person, I'll put it in parentheses here, is willing to spend $310 for a single item, up from $277 in 2021 and up from $157 in 2020. Do you think this study accurately reflects the average American consumer?
I would say, yeah, I believe that dollar amount is probably accurate. What's more difficult for me to believe is a stat that I found that says 73% of Americans claim the majority of their purchases are impulse purchases. That just doesn't compute with me. I don't have any experience with that level of impulse buying.
Sure, Alex Russo, though.
Yes, but $314 a month. I mean, do the math. It's only like $10 a day. You know, somebody decides to stop off for a cup of coffee or buy an album on iTunes or whatever. I could absolutely believe that.
I can absolutely believe it too, but I have an impulse buy category. It's called my mad money. So it's really not like I'm doing a bad thing by spending. So in this study, are they saying, oh, these people are spending money that they otherwise don't have or ought not to be spending? So I think that would be something to look at. And as far as the other thing that you found, Alex, does an impulse buy mean that I'm like, oh, I impulsively paid my mortgage, or like I impulsively paid my car insurance premiums? I find that one hard to believe too.
I think that after a while we become velocitized, or we get used to the paradigm of working at Coco Enterprises. Is that you people applied for a job in a particular industry that attracts people who are relatively good with money to begin with, and secondly is that we tend to attract people who have money, who by definition tend to be pretty good with money. There's a whole super majority of Americans we never see, and as a result, they are impulse buying. And, you know, Alex, I wouldn't doubt it if you rations toilet paper squares to his family. He's so tight, he squeaks when he walks. But the average American's not that way. And when they go shopping, they don't have a list when they go buy and they go, oh, I think we'll have some spare ribs. And, oh, this spaghetti sauce looks pretty good. And yeah, it's been a long time since I've had grapefruit juice. And they just buy stuff because they have a whim to buy it. It's not like they went with a plan saying, we need grapefruit juice or we need spare ribs. They buy on impulse. They go to the store because they go to the store every Wednesday and Saturday, and they spend until the money is gone. Now, we don't see those people because they don't have any money. But there's lots and lots of Americans who live paycheck to paycheck. And I'm pretty comfortable with the numbers. I think they're accurate.
So the number, like when I was in graduate school, the thing that they beat us over the head with the most is how many people are part of a study. Because if you can tell right away how good a study is by the number of participants in it. And this had 2,000 people in the study, which when you're trying to extrapolate that to the entire American population, I don't think is a very good sample of the entire American population. I think what Joe says is probably accurate. But I would say that based on like a 2,000 person study, that this may not be, real accurate. And then secondly, they didn't really find impulsive buying. So is that like, again, like Drew does, like I have my man money, and sometimes I save my man money for things that I want to purchase. And then some days when I'm driving into work, you know what, I think to myself, you know what, I'm going to stop and get a cup of coffee. You know, and I know in my head that this is going to postpone whatever I'm saving for, but it's part of my mad money. And I'm not going out of my way to purchase it. And it's still within my budget, but it is somewhat impulsive because today is like, I decided to buy coffee instead of, you know, add another $5 to whatever I'm saving for. But again, I planned for it. So they don't differentiate like what exactly, or they don't define what an impulsive buy is. So I have known people who have like impulsively bought a Chevy pickup truck. And so I think there's definitely some truth to what Joe's saying.
Well, I know this is supposed to have been a lightning round question, but it's turned into not one. In the same article, I didn't include a ton because I only wrote 2 sentences here. But in the same article that I read, about 73% of Americans saying the majority of their purchases were impulse purchases. They said the number one impulse purchase is done on people's phones. It's not at the grocery store. It's not at, on the drive to work or anything like that. It's people sitting on the couch buying stuff they don't probably need impulsively. At least that's what I think that article was implying. I'd have to go back and find it and get more data, but I think at least with that particular article, that's what they meant is people are just sitting on their couch watching TV, clicking buy.
I guess I believe that then. So
Yeah.
all right. For everyone that so for everyone that did not file an extension on their taxes for 2021, the tax season is over, and many want to know which financial documents they should get rid of and which they should keep. What would you tell them?
Well, me personally, if it was in my tax folder for the year, I generally just don't get rid of it until 7 to 10 years later. I open up a file cabinet and it's, oh, these are from 2011. I got to throw that out. So yeah, in general, I mean, if you used it for taxes, I'd probably just hang on to it unless, you know, space is a huge problem for you.
I'd say you can get rid of pay stubs and account statements. Generally, those can be found from your employer and in your account anyway. I tend to save everything just like Alex. If it was used for taxes, it goes in the tax file, and it'll probably be there for as long as I live, or I might clean it out after a decade or so. But what I've heard is 3 years is kind of the number. After 3 years, generally that's beyond the IRS look back for an audit. So you should be safe getting rid of all tax documents that point forward.
I say that when you keep your files, is that anything that has been around for 7 years or longer, get rid of it. So in 2022, you go back to what 2014 and just take everything from that date and throw it out. People keep stuff, and what happens is that you have to buy more and more filing cabinets when you really don't need more filing cabinets. You just need the discipline of throwing stuff out. So if it's 7 years or older, get rid of it. Plus, if you die and you keep all that stuff, just complicates it for whoever's doing your estate plan when you die.
Absolutely. No, and all of this is right on the IRS website. It says a period of limitations that apply to income tax returns. So it basically spells out the things that you need to keep and the duration for which you need to keep them. If you want to be absolutely, say, 7 years, if you want to be a little bit more on the liberal end, 3 years would be just fine. My favorite bullet point from the IRS is that you should keep records for 6 years if you did not report income that you should have reported. So just in case they find that out, you might want to keep those. If you didn't do that, you might want to keep those for 6 years, according to the IRS, right on their website.
I want to break that rule.
Yeah. There's a number of those in there that are kind of fun to read. So
I'll throw one more thing out with that one is most of my files are backed up on hard drives and thumb drives. So I don't have physical files of them. So that's always an option if you don't want to have the physical real estate in your house taken up.
That's a good idea. All right, here in Montana is starting to get warmer and temperatures are starting to consistently stay above freezing, which technically means that you can start planting. Have you started planting anything this year?
So the only thing so far I've done has been grass seeds. 2 years ago in that windstorm, we lost several trees. We had that process killed a septic system that was already on the way out. So we had to get hooked up to the city sewer, and our yard was all dug up. So for the most part, the lawn came back real nice, but there's a few patches that needed some work again this year. So that's been priority one, getting the lawn back to normal with grass.
I haven't planted anything this year yet. I do have asparagus coming in from planting last year, which is pretty nice. Or was that 2 years ago?
Last year.
Last year, yeah. But I plan on, I think we're putting in our seeds this weekend, if I'm not mistaken. So look forward to getting the garden going then.
We have not planted anything new this season, but we need to. I'm waiting for 2 days in a row where the thermometer is above 65 degrees to put my tomato plants in. But if you take a look at our break room, it looks like a jungle back there where we should have planted them when they were a foot tall. And right now they're like 2 feet tall and they're crawling underneath the doors and everything at this point. So it's time to get them planted, but it's been too cold.
It's like that scene in Jumanji when all the vines are like going into the house, under the doors, into the wall.
Despite my best efforts with a weed whacker, our raspberries are actually growing, and we have rhubarb. My task this last couple of weekends was to get rid of all the weeds and dig up a bunch of stuff. And I unfortunately got some plants and some perennials that we had planted last year, but a few of them are coming back, and we got a lot of raspberries this year. I don't know what happened, but so I've inadvertently planted some raspberries, but we haven't planted anything yet.
Yeah, our raspberries are coming in pretty nice too so far.
I actually had some stuff growing on my compost pile too, which is interesting. But I don't know what I threw in there, so probably won't eat it. So. All right, that's it for episode 39 of Farm to Markets. We'll see you next time.